Welcome to the Riskwiser Zone. I'm your host, Louis. Today, we're diving into the world of stocks and finance, where uncertainty and risk are always lurking around the corner. As we navigate these complex markets, it's essential to stay informed and up to date on the latest developments. We're starting with a story that highlights the potential benefits of a no-cut scenario for certain sectors, particularly banking and energy. With the Federal Reserve deeply divided on its next move, some investors are betting on a paralysis in monetary policy, which could lead to a surge in bank stocks and oil prices. The Invesco KBW Bank ETF, for example, has fully recovered from the 2023 mini-banking crisis and is now seen as a safe haven, yielding 2.25% with rising dividend growth. Meanwhile, the State Street SPDR S&P Oil and Gas Exploration and Production ETF is already up almost 30% this year, driven by the conflict in the Strait of Hormuz and the resulting spike in oil prices. Another sector that's gaining attention is uranium, with the Sprott Uranium Miners ETF surging over 91% in the past year. As countries expand their nuclear power capabilities and data centers require stable power sources, uranium is becoming an increasingly strategic commodity. It's essential to note that these trends are highly dependent on various factors, including geopolitical events, monetary policy decisions, and market sentiment. As investors, it's crucial to approach these opportunities with a nuanced perspective, weighing the potential risks and rewards. We'll continue to monitor these developments and provide you with in-depth analysis and expert insights to help you make informed decisions. Whether you're a seasoned investor or just starting out, we're here to guide you through the complex world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of personal finance and investments today. Our previous segment dove into the intricacies of tax season, and now we're shifting gears to discuss a crucial aspect of retirement planning: Roth IRA conversions. As we consider our financial futures, it's essential to understand the implications of converting traditional IRAs to Roth IRAs. A recent article caught my attention, highlighting Vanguard's break-even tax rate, or BETR, model. This approach helps investors determine whether a Roth conversion is beneficial based on their individual circumstances. The traditional method of evaluating Roth conversions focuses on comparing current and future tax brackets. However, the BETR model takes into account opportunity cost, portfolio growth, and how taxes are paid, providing a more comprehensive analysis. By using this model, investors can make informed decisions about their retirement funds. Let's consider an example. Meet Jill, a high-income investor with $100,000 in a traditional IRA. She expects the account to triple in value over 20 years and anticipates her tax bracket will decrease from 35% to 24% in retirement. Using the BETR calculator, we can see that her break-even tax rate is approximately 23.3%. Since her expected retirement tax rate is slightly higher, the Roth conversion makes sense, but only marginally. It's crucial to note that everyone's financial situation is unique, and what works for Jill may not work for others. That's why it's essential to consult with a financial advisor or tax professional before making any decisions about Roth conversions. They can help you navigate the complexities of retirement planning and create a personalized strategy tailored to your needs. As we continue to explore the world of personal finance, remember that knowledge is power. By understanding the intricacies of Roth IRA conversions and seeking professional guidance, you can make informed decisions about your financial future. Welcome back to the Riskwiser Zone. We're closing out today's show with a look at some significant developments in the world of finance. First, we have a story about the growing trend of Indian companies using initial public offerings, IPOs, to raise capital. Recently, it's been reported that many of these IPOs are being used primarily for debt repayment rather than funding business expansion or growth initiatives. This shift has raised some eyebrows among investors and analysts who are questioning the long-term sustainability of this approach. In related news, Reliance Industries' telecom unit, Jio Platforms Ltd, is gearing up for what could be India's largest ever IPO. The company has appointed a team of 17 bankers to handle the issue, including global banks like Morgan Stanley and Goldman Sachs. While details are still being finalized, the proposed offering is expected to comprise largely of secondary share sales by existing investors. Meanwhile, the Indian banking system is experiencing a liquidity squeeze due to tax outflows. The Reserve Bank of India has responded by conducting open market operations worth 1 lakh crore to inject liquidity into the system. However, the impact of this move remains to be seen, and experts are closely watching the situation to determine its effects on money market rates and overall economic stability. As we wrap up today's show, it's essential to remember that investing in the stock market always involves some level of risk. It's crucial to stay informed, do your research, and make informed decisions to minimize potential losses. Whether you're a seasoned investor or just starting out, it's essential to approach the market with caution and a clear understanding of the risks involved. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.